All right, let's dive into something that might sound a little technical, but I promise you it's absolutely crucial if you want to understand how private equity really works. We're talking about the management fee offset. It's the key to the whole relationship between a fund and its investors. So let's get right into it. So let's just start with a simple question, right? Could a fund manager actually get paid twice for doing the same job? I mean, it sounds like a pretty obvious conflict of interest, doesn't it? Well, you're right. And that is the exact problem that fee offsets were designed to prevent. So, here's our game plan. First, we're going to break down this double dipping problem. Then, we'll see how fee offsets are the solution. We'll look at the new industry standard, what kinds of fees are involved, and then, this is the juicy part, the hidden tax and legal traps. And finally, we'll talk about why every single word in the fine print matters. Okay, first things first. Let's really get to the heart of the conflict here. The entire reason fee offsets even exist is to solve this one fundamental problem baked into the economics of a fund, what people call double dipping. Think about it like this. As an investor, an LP, you're already paying the general partner, the GP, a management fee to, well, manage the fund. But what if that same GP then turns around and starts collecting fees directly from the very companies that your money was used to buy? That's the double dip. You can see how that creates a massive conflict of interest, right? So, how do we fix this? Well, thankfully, there's a pretty elegant solution. It's a contractual tool called the management fee offset. Okay, so what is it? A management fee offset is basically just a rule, a clause written into the fund's legal DNA, the Limited Partnership Agreement, or LPA. And it says that the GP has to give investors credit for certain fees they collect from the fund's companies. The bottom line here is that it stops the GP from getting paid twice for one job and keeps everybody's incentives aligned. It's all about fairness. The process itself is pretty simple when you break it down. Step 1, the GP earns some kind of fee from a portfolio company. Step 2, that legal agreement, the LPA, kicks in and triggers the offset. And boom, step 3, the management fee that you, the investor, owe gets reduced by that exact amount. It's a direct dollar-for-dollar benefit back in your pocket. And this is where you can see the real-world impact. I mean, look at this. If a GP collects $1 million transaction fee and there's a 100% offset in place, that is $1 million that investors don't have to pay in management fees. It's like the portfolio company itself is paying for the fund's operating costs instead of the investors. It's a huge deal. Now, this whole system hasn't just stayed the same over the years. The market standard for these offsets has actually evolved quite a bit, becoming much more friendly for investors. You know, back in the day, an 80% offset was pretty common. That meant the GP would still get to pocket 20% of those extra fees. But today, largely thanks to influential groups like the Institutional Limited Partners Association, or ILPA, a 100% offset is the gold standard. It's what they call a hygiene factor now. Basically, if a fund doesn't offer it, investors are immediately going to ask, why not? So, what kind of fees are we actually talking about here? What exactly triggers these offsets? Let's get into the nitty-gritty. The list is pretty comprehensive. We're talking about transaction fees for buying and selling companies, monitoring fees for oversight, advisory fees for strategic advice, even fees for sitting on the board of directors. Basically, the expectation now is that any income the GP earns from interacting with these portfolio companies gets credited right back to the investors. But, and this is a really big but, here's where the story takes a fascinating and slightly scary turn. What started as a simple, elegant solution to one problem accidentally created a whole new set of really complex tax and legal risks. Okay, for tax-exempt investors, think university endowments, charitable foundations, this is a huge deal. Their whole model relies on their income being tax-free. But the IRS might look at these fee offsets and say, wait a minute, this doesn't look like passive investment income. This looks like you're being paid for services. And that simple change in perspective can trigger something called unrelated business taxable income, or UBTI. All of a sudden, an institution that was expecting to pay zero tax is hit with a surprise and potentially massive tax bill. It's a perfect example of unintended consequences. And if the tax risk wasn't enough, the legal risk is even scarier. The Sun Capital case sent absolute shockwaves through the private equity industry. A court basically ruled that because the fund was charging all those service fees we just talked about, monitoring, advisory, and so on, it proved the fund wasn't just a passive investor. No, it was actively engaged in a trade or business. And here's the terrifying part. That ruling meant the fund itself, and maybe even its other healthy portfolio companies, could be on the hook for a single failing company's giant pension obligations. We're talking hundreds of millions of dollars in liability appearing out of thin air, all because of how these fees were structured. All of this, the conflicts, the solutions, the hidden traps, it all brings us to our final and maybe most important point. In this world, the fine print is literally everything. This quote really says it all. A few words in a document that's hundreds of pages long can be the difference between a great investment and a multi-million-dollar liability. Is the money an offset against fees payable, or is it treated as a distribution to LPs? It sounds like legal jargon, but as we've just seen, it's not just semantics. It changes absolutely everything: the tax implications, the legal risk, and the entire financial outcome for every single person involved. So, in private equity, every word matters. The real question is, are you reading them closely enough?